The last model that I'm going to talk about is the one that's hardest to do and takes the longest amount of time. It's a discounted cash flow model, and it's based primarily on the assumption that the value of any asset is equal to the present value of all of the cash flows that you'll get from that asset. So if you take all of the cash that you expect to earn and you adjust it for the time value of money, so that money received in the future is not worth as much as money received today, and you add it all up, then that's the value of an asset. And the value of a business is calculated the same way, because a business is an asset. So, so essentially, what you're going to look at for a business value is you're going to look at all the cash flows that are generated by that company. And in the case of a business, the cash flows that are generated are usually estimated by the profits that are earned. And there's a few adjustments that we're going to make to that. But if you just take the present value of all future cash flows that you receive, that gives you the business value. And that essentially will calculate what you would need to pay to buy that company. One important thing is we ignore capital structure, because it shouldn't make any difference whether the business is financed by debt or equity, because you can adjust that in any way. So you don't deduct interest expense. What you want to say is, what is the amount of profits or cash flow generated from that business total? And then later you can decide whether you want to finance it with some debt or whether you want to keep it all equity. And in order to do that, you are going to take only part of the income. So you can't take net income from an accounting statement, because that already has interest deducted. Now remember that the business value that we're calculating here is the enterprise value. Okay, so it's a debt plus equity. And essentially the enterprise value is going to be the present value that we end up with a calculation. Okay, so if we were to do the future cash flows of a company, and I'm going to ignore interest, as I said. So I'm going to use EBIT. EBIT is the earnings before interest and taxes. And then multiply that by 1 minus the tax rate. So essentially what this is coming up with is the after-tax income if you exclude any impact of interest expense. And that reflects the cash flows that we want to consider for the business, because we do have to pay taxes. But if we choose not to finance any of it by debt, then basically you don't have to pay any interest. Okay, so this is all the cash that will be generated in the future, regardless of the capital structure. So the present value is, or the enterprise value of the company, is just going to be the present value of all of these cash flows. And if you were to do a simple projection, though, in theory, what you would need to do is project out to infinity how much every year the company is going to be earning in cash flow. And when you take present value of that and that future cash flow stream, that gives you the value of the business. But that's not, you can't project out to infinity. Usually people project out for 5 years. After 5 years, it becomes sort of a guess anyways, depending on the nature of the business, sometimes even before 5 years. But let's assume it's a relatively predictable business, and this cash flows that we're going to get are 100 year one, 125 year two, and then it sort of levels off at 150 after that. Now those are 5 years of cash flow, but there is a terminal value. There's a value to the business that continues on after year 5. And there's a couple of different ways you can get that value. It's going to be an estimate in any of those ways, but I'll call that the ending value or the terminal value. So that also is a cash flow that should be considered in the value of the business. So if you take the present value of all of those, the individual 5-year cash flows, plus the present value of the ending cash flow, that's going to give you the present value of the business as a whole. So the other thing to consider is then how do you take the present value and you're going to discount it at a certain discount rate. And the rate that you would use in this case to value the business is the expected rate of return that the investor would like to receive. Essentially, that's their opportunity cost. For a company of this risk level, they want to receive at least this much return